This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil. In today's video, what I'm going to cover is I'm going to look at using multiple time frames to really kind of understand when to take the two of two. So I talk about a 1, 2, 3 change in trend, and one of my favorite entries is when we get a 2 in one time frame and then a 2 in a second time frame. And what ended up happening sometimes, though, you have to take certain things into account. It's the reason why we use MACD and ADX, and I'm going to show you exactly why I incorporate those into my trading. Now, one of the things I want to point out is that I'm using another short example. I'm not trying to convince people to start shorting. In fact, I actually think the market's looking much, much better. But I go through recent examples of movement in the market. I don't like to go back years. And so if I just go back in the last month or two, a lot of setups took place as a shorting example that are really good examples of what I'm trying to teach. So let's go ahead and get going with that. Now, if you want to learn more about some of these techniques, I would suggest starting with the book. It's at rabilstockresearch.com/book. Also, if you do enjoy this content, please hit the like button and also subscribe. Okay, so I have the chart of Capital One Financial up, and I have the same, grid that I use. I have a monthly in the bottom left, a weekly in the bottom right, daily in the upper right, and an hourly in the upper left. The only thing that I've added is I've overlaid the zigzag indicator on top. And I think it's a really good tool, especially when the market's volatile, to keep yourself in line. You can't make up anything when you're looking at these. If you don't get a swing that is a legitimate swing, it won't show up on the zigzag. So it just kind of helps you from fabricating setups, all right? And so that's something we want to avoid when the market's volatile. It keeps us a little bit more selective. So what I want to point out, I'm going to look at a couple of things that I think are pretty important. So if you notice, I've already drawn, on the daily chart, I've drawn this trend line break. All right, now this was the higher high, and we go back to the previous swing low prior to that higher high. So we make a higher high here, and this is our trend line anchor. All right, and then we go back in time, and we just want to make sure we're not passing through prices. So we can go back in time, and this would be the low that we'd use. If we use this low for our trend line, just to give you an idea, let me just draw this in so you can see. If I draw this in and use this as the anchor here, you see how we pass through all these prices here? We're passing through all that. So we can't use that, so we have to go to the next higher low. So I know this is the low of the pullback, but this is actually the trend line we want to use. This is the starting point for the trend line we want to use, because this is our anchor point. All right, once we break that trend line and then we rally back into the zone between the 18 and the 40, both are declining. All right, now let me just point out a couple things. So we break that and we rally up into this area here. We're in the 170, 180 area. All right. If you notice where that's taking place, we're breaking the 18-week and we're forming a little 40 to 18 bounce. Now, all these patterns are in my course. In fact, most of them are in my book, but I go into a lot of detail in the courses. So this is a 40 to 18 bounce here, where we bounce off the 40 and rally back to the 18. And if you notice what's happening here, we have room down to about 155 to the 18-month line, and about 150 to price support. So if I'm looking at this trade, in the call it the 170s or something like that, then I know I need to have the risk reward that makes sense to get down into the low to mid 150s. So if I'm going to create a trading plan for this individual setup, I've got to make sure that if I do it, the risk reward makes sense. All right, so we got to know that much. We know where we're using all these time frames to help. We're using the 18-month as kind of a target area. And the reason why we're not thinking this is going to roll over is because look at what's going on. look at what's taking place on this monthly chart. You see the strength of the MACD and the strength of the ADX. We're just looking for a pullback in an ongoing trend. We're not looking for a reversal on this time frame. The other thing I'd tell you is that this failure, this 40 to 18 bounce, this failure at the 18 was taking place above the zero line with no real sign of selling strength so far. So we have to treat anything we're doing on these time frames as a trading play. All right, now let's start to zero in on what's actually taking place. We get this move to the downside and we make a move up. All right, we've got these lines declining, and we could argue that we're looking for a signal here. All right, we've got a lot of strength to the downside. Now, this is the one thing that's going to help us here, because I want to show you. In fact, let's look at the hourly chart in this sequence, because I want to make sure you understand what's actually taking place. If we ignored that crossover on the daily, the MACD overrun, we could have been interested in playing this 1, 2 here. All right. Now, I want to pull them both up at the same time so you can see what I'm talking about for sure. You had a 1, which was the break of the trend line, and 2 is this rally up, and we're starting to form a top. Now, what I say is that we don't know that we've made a top unless we actually make a top on this time frame. If we make a top on this time frame in reverse, then we can say we have formed the 2 here. All right. But because this had rollover, we know in my rules, I say look for the second signal, not the first signal. A lot of times what happens is you come down and then you come back up. Well, if we did the first signal here, this was the 2. This right here was the 2. And you could have argued that that was a 2 of 2. But MACD saves us here. All right, ADX did not. ADX was showing a lot of strength to the downside, but the MACD crossover says, look, we don't think it's going to go straight down when this happens. When we get a crossover, a lot of times you'll wiggle around and you form a second signal. So what ends up happening is we make a little jet move here, which would have likely stopped you out of your initial trade. And then we get another move to the downside. We can take this trend line break and look at this 2. Now we have a 2 of 2 that's in line with this and also in line with what we were seeing in the MACD and the ADX. So now everything is in line together. I'm hoping this is making sense. This is a really important minor detail that if you ignore this and you say, I've got a 1 and a 2 developing on this time frame, I'm going to short this here. Odds are this poke back up stopped you out if you were using 2 times the ATR. Most likely, I didn't do the math. I didn't actually look to see if that were true, but I know in my world, I'm not going to take this first signal when I get a crossover like this. Now, the same patterns will develop on the long side. You want to be aware. I'm just using this as an example because it was recent. So it was a good short-term trading play because we had room here shown on the monthly chart, and we were failing at the 18-week as well, and we had room to the zero line. So all of these things are kind of put together for you to take short-term trading plays if you want to do that, if that's your game. I'm not suggesting that you do it, and I'm not even suggesting that you short stocks in an uptrend. But I'm telling you, these tactics can be used, and we want to make sure we're following the details of the program. The program says if MACD crosses over, we shouldn't expect a straight down signal. You should expect some kind of a double top to form or something like that. That's what takes place here, and that's why on the hourly chart, we're much more interested in this second signal rather than the first one. All right? Let me know if you have any questions, and we'll see you next time.